Make sure to claim your 2 free stocks with Webull. What is a debit spread? A debit spread or a net debit spread is an option strategy involving the simultaneous buying and selling of options of the same class with different prices, requiring a net outflow of cash. The result is a net debit to the trading account. Here, the sum of all options sold is lower than the sum of all options purchased. Therefore, the trader must put up money to begin the trade. The higher the debit spread, the greater the initial cash outflow the trader incurs on the transaction. How a debit spread works. Spread strategies in options trading typically involve buying one option and selling another of the same class on the same underlying security with a different strike price or a different expiration. However, many types of spreads involve 3 or more options, but the concept is the same. If the income collected from all options sold results in a lower money value than the cost of all options purchased, the result is a net debit to the account, hence the name debit spread. The converse is true for credit spreads. Here, the value of all options sold is greater than the value of all options purchased, so the result is a net credit to the account. In a sense, the market pays you to put on the trade. Example of a debit spread. For example, assume that a trader buys a call option for $2.65. At the same time, the trader sells another call option on the same underlying security with a higher strike price for $2.50. This is called a bull-call spread. The debit is 15 cents, which results in a net cost of $15 to begin the spread trade. Although there is an initial outlay on the transaction, the trader believes that the underlying security will rise modestly in price, making the purchased option more valuable in the future. The best-case scenario happens when the security expires at or above the strike of the option sold. This gives the trader the maximum amount of profit possible while limiting risk. The opposite trade, called a bear put spread, also buys the more expensive option while selling the less expensive option. Again, there is a net debit to the account to begin the trade. Bear call spreads and bull put spreads are both credit spreads. Profit calculations. The break-even point for bullish debit spreads using only 2 options of the same class and expiration is the lower strike plus the net debit total paid for the spread. For bearish debit spreads, the break-even point is calculated by taking the higher strike and subtracting the net debit. For a bullish call spread with the underlying security trading at $65, here's an example. Buy the $60 call and sell the $70 call for a net debit of $6. The break-even point is $66, which is the lower strike of 60 plus the net debit of 6 equals 66. Maximum profit occurs with the underlying expiring at or above the higher strike price. Assuming the stock expired at $70, that would be $70 minus $60 minus $6 equals $4 or $400 per contract. Maximum loss is limited to the net debit paid. Well, that's it for today's video. Don't forget to smash the like button and subscribe to our channel.